and welcome to the Citizens Monetary Policy Committee meeting. In June this year, CNBC-TV18's started a new initiative ahead of the monetary policy. On June 7th, we had constituted a Citizens Monetary Policy Committee which had discussed and voted on what the Reserve Bank should do in the policy. For the record, our committee had voted no change in rates and the Reserve Bank abided by their advice. With the next policy due on August 9th, we have once again convened a meeting of our Citizens Committee, which starts this very minute. Let me welcome Chairman of the committee, Dr. Pranab Sen, and members Samiran Chakraborty of Citibank, Soumyakanti Ghosh of State Bank, Sajid Chinoy of JP Morgan, and Sonal Verma of Nomura. The format is as follows. The committee discusses the growth and inflation and liquidity trends of the past quarter. Also, any other issues that it may deem necessary for the Reserve Bank to take note of. It will vote on the policy action they desire. And also, the committee has the right to make recommendations to the Reserve Bank for further action on any front: liquidity, banking regulation, financial stability. So without much ado, gentlemen and lady, welcome. Chairman Sen, the last reading of inflation was 5.8% in June. The fourth quarter GDP was 7.9%, and the last core sector reading that we have is 5.2%. Your assessment of growth, does it need help? Your assessment of inflation, and do you think rate action is possible?
Well, as far as growth is concerned, I don't think it needs very much help at the moment. But as far as inflation is concerned, I think we need to be a little cautious. One of the good things that's happened since the last policy is that there has been a significant easing of liquidity, which had been constraining the development of the economy in the prior year, or more than a year actually. However, we are now, I think, at a tipping point, and I think the RBI has to take a call not about whether liquidity should continue to be eased, but the pace and the timing of the easing. We should be aware very clearly that with the kind of monsoons we are having, we are going to get a great kharif. Now that's going to be very good for prices, but a great kharif almost always means a huge amount of procurement, which means a huge sucking out of liquidity from the banking system. And that's something we need to bear in mind. And the question that RBI needs to ask is, do we continue to pump in liquidity at a regular basis from now until November, December? Or do we wait a little bit and start the easing of liquidity again closer to the date?
Sajid, the growth and inflation trends and what needs help now?
So before we get there, let me say, between the last time we met and this time, we've almost seen an intermeeting cut, so to speak. If you look at how liquidity has changed, the RBI's new framework and the global bond yield rally, T-bill rates have rallied by 25 basis points in the last 6 weeks, G-Sec yields around by 25 basis points, and liquidity is basically at neutral. This is tantamount to there have been a rate cut in the last 6 weeks. Interestingly, despite that, we haven't seen much softening in either bank deposit or lending rates, raising the larger question of whether those rates are sticky only because of tight liquidity conditions, or are there more fundamental factors at play. I think on the inflation outlook, the RBI signaled there were upside risks to the 5% forecast for next March. My suspicion is the risks are more balanced now for a couple of reasons. A, we've seen the monsoon start pretty strongly. The spatial distribution has been good. Pulses, which are a key driver of inflation, their sowing is 40% above normal. Now, we have to be careful. They were 40% above normal this time last year, and actual production was 4% below normal. But the fact is, if these trends proceed, even though there's no direct connection between the monsoon and food inflation, these should have some depressing effects on food prices. Secondly, oil prices are down 25% since the RBI last met. $50 a barrel is now at 40. Finally, I think if you look at core prices, they've been very sticky for 15 or 16 months. Just the last month there's some softening, and if you look at the first half of the results season, you're not seeing much pricing power. So if you put all these pieces together, which is a good monsoon, oil is down 25%, there's not too much pricing power, despite the fact that there's a pay commission that's going to come in, and despite the fact that inflation surprised to the upside, my sense is you're tracking 5% and the risks are more balanced for the moment.
Okay, risks balanced. I'll come to your action recommendation in a minute. Sonal Verma, do you think the Reserve Bank will get to 5% 5%. I mean, we were expecting that it would be 5.4 or less in June and in May, June and July. The numbers have actually turned out to be 5.8. Is there a danger to 5% inflation target in Jan-March?
Since the last policy, actually inflation readings have surprised on the upside, and the upside risk has come primarily from food prices. So, you know, one is hoping that food prices will ease. But I think broadly there hasn't actually been, unfortunately, any big movement on the macro front. You know, we are yet to see growth significantly accelerate. There's been no broadening out of the growth recovery. And similarly on the inflation front, you know, headline has been volatile, but there's been no significant deceleration in the inflation momentum. Now, 5%, are we going to meet the 5% target? I think risks actually are a bit skewed to the upside, primarily because, you know, the uptick that we were expecting on account of the allowance increase, you know, for the pay commission, that has been put off till October, till the committee decides on what to do with it. So I think if that gets implemented sometime in early 2017, then for the March 2017 target, actually there could be some upside risk stemming from there. So risks are actually still a bit on the upside, you know, in my view.
Okay. Well, Samiran, you know, as it is, the RBI's fan chart was indicating below 5.4%, 5.5% for the past 3 months. The index has not remained at that level. As Sajid said, and Sonal has pointed it out also out in some of her reports, the monsoon and relation to food inflation has been a very weak one. Are you certain about the 5% achievement with or without the pay commission? Does the Reserve Bank have any space for easing up until January?
Well, the way to look at it in my mind is that the inflation path is not going to be uniformly down. So in the next 2 months, you are likely to see 2 prints which can be above 6% also. Okay. But having said that, after that, the base effect kind of catches up with you. And particularly on pulses, our view is that the pulses inflation could come down to single digit if we are lucky, partly because of the base effect and partly because of certain global glut in pulses, because Indian production, if it goes up, and the world production, if it is tuned towards 5.8 million tons of imports from India, then we might see a situation where you have pulses prices correcting quite suddenly. And on top of it, the pay commission effect, if it is the house rent allowance is deferred, last pay commission we had seen that for the house rent allowance to actually figure out in the CPI data, it took 9 to 12 months. Okay. So it could well be the case that for the January-March 2017 quarter, we do not see the effect of the pay commission coming in. Yes, it will be kind of a Damocles sword hanging on top of your head. But overall, it's in our view still possible to meet the 5% target. Let's not forget that if you take out the veggies, sugar and pulses, which is 10% of the weight in CPI, the rest 90% is growing at just 4.3%. So if these 3 things correct to some extent, you could still see 5% within the realm of possibilities.
Okay. Well, Shaumya, let me change the question and make it more forward-looking for you. The Monetary Policy Committee's mandate is to reach ultimately a 4% inflation plus or minus 2. So given that ultimate goal and this Damocles sword of the pay commission, how much space do you think the Reserve Bank has to ease? And let me dovetail it with liquidity. That seems to be providing a lot of space for actual rates to go down.
No, I think if I just take the second question for the liquidity part, I think if you look into the liquidity situation which was in April and in July, in April we had a liquidity deficit of core liquidity deficit, and today we are sitting on a liquidity surplus. So from that point of view, liquidity is plentiful, and that has actually prompted the yields, the money market yields to go down significantly from the current levels. So that's the first thing. The second thing is that because of this yield declining, the problem is that the banks are paring their MCLR rates. But as Sajid was pointing out, I think there are some fundamental and structural issues which may prohibit the banks of cutting their deposit rates and possibly the lending rates more fiercely in the coming months. The most obvious reason is the FCNRB outflows. So because of that, and given the fact that deposits are currently growing at much below the historical trends, banks will be a little bit reluctant to cut deposit rates because they don't want to lose their deposit base. So that's the first thing. So if we rule out that hypothesis, then the lending rate transmission, which may have happened because of the liquidity, may not continue in the same pace. So that's my first point. The second thing is regarding the inflation trajectory is concerned, I think yes, after the last trends, if you look into the data, food prices have continuously surprised on the upside, and there is every possibility that this month also the food prices, the pulses and the cereals actually have grown at a much higher rate than last month, even though the veggie prices have dropped in the last fortnight. So my sense is that you could see some amount of unfavorable inflation, but purely driven by food, because core inflation has remained at 4.5% steady for the last 15-16 months. And after that, because of the base effect, inflation moderates, possibly hits the 5%. I will say possibly because I don't think that the 5% is sacrosanct as of now if the food inflation continues to move at that level. If that is the case, then the rate cut option which the RBI is having right now may be a little bit limited, even though I still believe that there is a possibility of further monetary accommodation on the part of RBI in the second half of the current fiscal.
We need to dwell a little more on liquidity. We'll take a break, but we will come back and discuss those two other factors that impact the transmission of cheaper money to the system, the amount of liquidity and the NPA situation in banks. Back in a minute.